Good morning again, and welcome to the Haven Financial Group radio show. I'm Larry Colvig, founder and CEO of the Haven Financial Group. Thanks for listening. Talking about taxes and tax strategies today. Give us a call at 612-504-8400 or visit us online. Come to our classes. Just wanted to note, Kim, we're celebrating our 10-year anniversary of when we started Haven Financial Group, so we're excited about that. We just had a great annual Shred Client Appreciation event this past week. Very well attended. We took over the local restaurant, and we just, in appreciation to all the folks that we've been able to help over these 10 years, which, man, 10 years has gone by really, really quick. So, again, good to be talking about these things because people want to know, and it's evident by the amount of attendees we had this past week at our Social Security class. So we always encourage people to come out.
Absolutely. We do want to remind everyone those educational classes are available to anyone. You go to havenfinancialgroup.com and you'll see the classes that are coming up and where they are going to be held. Be sure you sign up. It costs nothing, but they do like to get a head count if at all possible. Again, that's havenfinancialgroup.com. Let's talk a little bit about taxes and investments. Of course, we have Lance Larson here, CPA with Haven Financial Group. And capital gains tax, that seems to be the one that people, obviously are the most concerned about. I think that's the one that people think about the most, Lance, when they're thinking about taxes in retirement. So let's talk about capital gains tax and just sort of an overview and how you sometimes suggest people deal with that issue.
So again, capital gains is going to be the difference between what you sell the asset for and what you kind of bought it for. Mm-hmm. It's really easy when we look at stocks that, hey, we bought it at $10 a share. It now went up to $20 a share. Mm-hmm. So that growth right there is we're going to be paying a capital gain of $10 a share. The other big one we talk a lot about is going to be your primary residence. You've lived there, you bought it many years ago, and you paid a smaller amount, and now today it's worth a lot more. And so there's going to be a capital gain on there. Fortunately for primary residence, there is an exclusion that we can exclude up to $500,000 of that capital gain for married couples there. And so most of the time, we actually don't really pay anything on the primary residence there. But the principle of calculating that gain is always going to be there. When we also look at capital gains, we need to know, is it a short term or is it long term? And the definition on that one is that long term is anything over a year. Mm-hmm. And the reason why that is very important is because there are different tax rates for short term gains versus long term gains. Our short term gains are treated just like ordinary income. So people who do a lot of day trading, where they say, oh, this one's going to go up by 1/4 point, so I'm going to invest my $50,000 here, watch the stock go up by 3/4 point, and they're over the moon, and they sell it immediately. Well, that's going to be a very short term, and that's going to be ordinary income for them. Mm-hmm. Versus most people, we're in it for the long haul. We were told to invest there and ride the market out there and then wait until retirement. And so now we have long-term capital gains. And why that's going to be important is because depending upon which marginal tax bracket that you're in, those long-term capital gains could be taxed at 0, 15, or 20 if we have a lot of income that's coming in. I do remember a client that we helped out a few years ago that had very little income because he'd retired, but he had a nice big portfolio of things that he'd invested in. We liquidated a whole bunch of his holdings, and he had about $100,000 of capital gains. And he had cash-wise, I want to say closer to about $150,000 to $200,000 of cash that came in. So it's not important to note that the cash that you receive from selling this does not equal your capital gain all the time. But in his situation with that $100,000 of capital gains and no other income, he actually paid no federal tax at all because he was in the 12% marginal tax bracket, wherefore his long-term capital gains were taxed at 0.
Mm-hmm. Well, Lance, let me ask you, are there plans that you can make? Are there ways to get around or minimize capital gains?
There are, and it's going to be more taking advantage of what income brackets that you're in.
Mm-hmm.
So at a bare minimum, the long-term capital gains are always going to be at a preferential treatment. So we're not going to necessarily get around paying them unless we keep them in the lower tax brackets, and then we can actually use that 0% for our capital gains. It's the only true way of getting around that one. But I will also note that even if you are in the 22 or 24% tax bracket, it is better to pay on the long-term capital gains at 15% rather than that 22 and 24%.
Mm-hmm. So that's the kind of advice that you can give people, and maybe also, I'm thinking about, well, I'm going back to primary residence, which you say is taxed at a very different rate, but just there maybe are some of these capital gains that need to be strategically, you gain them strategically so that they're not all at one time. Or
Exactly. So people who have these non-qualified accounts that they look and they call investment accounts,
mm-hmm.
that it kind of depends on what you're invested in there. One of the things that we also want to look at is there's tax efficient funds that are going to be in there. So typically mutual funds are funds that are going to cause us to have a lot of income because it's someone else that's controlling, and they are going to make a whole bunch of sales, and then the capital gains that they create in their fund are going to be passed upon to the investor.
Mm-hmm.
And we have clients that are invested into many of these funds, and we look at their statements throughout the year, no capital gains, no capital gains, no capital gains. And then we finally get to the December statement, which is now too late for us to really do much. And the hedge fund manager sold a bunch of stock to get a whole bunch of capital gains. And now our investor, he has a $30,000 capital gain distribution.
Mm-hmm.
It makes for a nightmare for tax planning purposes there. Whereas if instead of being into that mutual fund, you could be invested into an ETF, which will give you the exact same risk portfolio that you're looking for, can give you the exact same type of growth, but it's not going to produce all those tax problems for us at the end. And this is one of those things that we want to have clients come in and talk with Larry and with Kyle, and then we can look at what are you actually invested in with these things?
Mm-hmm.
And does this make sense in one for their risk portfolio, and two, from a tax perspective?
Sure.
Kim, all the time, as we look at portfolios, and again, at Haven, we do wealth management. We're not small. We manage with Charles Schwab and Fidelity Investments. We have an investment team of 12. You know, I'm sure listeners have noticed the market had been very volatile in the last couple months, like very volatile up and down. Yet that creates opportunities. And when I mean opportunities, tax loss harvesting, with more volatility becomes more activity for that opportunity to harvest some of these losses. Although we don't like them, we can sell investments that have lost value to offset capital gains tax. And that really reduces the tax burden. And I can tell you, I can think of numerous clients where we've saved them thousands and thousands of dollars in taxes, and they were extremely happy. Now, they maybe didn't know why, and they say, why are you doing this now? And when we explain it to them, it makes perfect sense.
Sure.
However, if you're don't have a relationship or a partner where you're having these discussions, and many times they're not even paying attention to your investments, they just set it and leave it and don't pay any attention, you're probably not utilizing these tax strategies, which are available to many people. And it just doesn't apply to those that are wealthy. Mm-hmm. It can affect those that actually have very minimal to those that have a lot of wealth. So don't back yourself in a corner, but have a partner, get it looked at. Like Lance mentioned, the right recipe in the right portfolios. Mm-hmm. There's certain types of investments that should go in non-qualified, that shouldn't go into IRAs, and that may be different to go into Roths. There's the right recipe and the right mix for the right types of accounts. And we see them all mixed up all the time. And we have the luxury, Lance has the luxury, I know numerous times this tax season, where as he's doing their taxes and looking what they made in interest, why did you do it this way? Why did your advisor sell these off? It just caused you this much in a tax burden.
Sure.
Did you know that? and they don't usually have any explanation. They have no idea.
Right.
We want to avoid those mistakes.
Mm-hmm. Rebalancing your portfolio to make sure that it keeps you away from those high taxes. Yeah, absolutely. Rebalancing and diversification. These are our two big words today, right?
Yep. These are the two big words: takeaways, rebalancing, and tax diversification. And if you're not having those conversations, come on in and visit. We can have those conversations. It might be well worth your while.
Absolutely. 612-504-8400. That's 612-504-8400. That's how you set up the appointment. Go on in and talk a little bit about rebalancing and diversification. When we come back, let's talk about estate taxes and how that affects your retirement. This is the Haven Financial Group Radio Show.